All right, welcome to The Explainer. Today, we're going to talk about a fund you've probably seen popping up online. It's got this number next to its name that just makes you do a double take. We're talking about the YieldMax Ultra Option Income Strategy ETF, or, ULTY for short.
So let's just put it right out there. This is the number. We've seen it hanging out in the mid to high 80s, and yeah, that's what's causing all the buzz. It's the reason people are getting so excited thinking about getting these weekly cash drops into their accounts.
But here's the million-dollar question, right? Is this thing actually for real? Is it too good to be true? To figure that out, we really have to peel back the layers on that massive headline number.
Okay, Section 1. Let's decode this thing. The absolute first thing you have to get your head around is that this 88%, it isn't yield in the way you and I normally think about it. It's not like the interest from a bond or a dividend from a blue-chip stock. Not even close.
See, what they're advertising is something called the distribution rate. All that means is they take the very last payout, multiply it by 52 for the weeks in a year, and voila, that's your number. But that's totally different from the official standardized metric that regulators make everyone use, which is called the 30-day SEC yield.
And get this. If you look up ULTY's official by-the-book SEC yield, it's zero. Zilch. Nada. So how is that possible? Well, it's because that standardized formula was designed for things like bonds and dividend stocks. It completely ignores the income from selling options, which for this fund is literally the entire strategy.
Now, there's another piece to this puzzle. Part of that huge payout you get often includes something called return of capital. And look, let's be blunt, that's just the fund giving you a piece of your own money back. It's not a profit. It can help you defer taxes, which is nice, but it can also be a sign that the fund's underlying value is actually shrinking over time.
And this chart here shows it perfectly. This is from a recent distribution. You can see the big chunk, about 87%, came from the income the fund's strategy generated. But look at that other slice, about 13%. That was just return of capital. That was them handing investors back their own cash.
All right, so if it's not dividends and the official yield is zero, where's all this cash coming from? How does ULT actually make the sausage? Let's pop the hood and take a look at the engine.
Okay, so the secret sauce here is a strategy called volatility harvesting. It sounds complicated, but the idea is actually pretty simple. They're trying to turn the wild, crazy price swings of certain stocks into a predictable stream of income for you.
And here's how they do it, step by step. First, they pick stocks that are famous for jumping all over the place. Think really volatile names. Second, they sell short-dated call options on them. You can think of this like selling an insurance policy against the stock price going way up. Third, they collect the cash, that's the premium, from the people buying that insurance. And fourth, they take that cash and distribute it to shareholders every single week. And who are they doing this with? Well, take a look. It's a who's who of headline-grabbing, super high beta stocks, companies like Coinbase or Affirm. These are the exact kinds of stocks where the options premiums are super rich. And why? Because nobody knows what they're going to do next. That uncertainty is the very thing ULTY is packaging up and selling.
Okay, so far it might sound pretty good, but you knew there had to be a catch, right? There's no free lunch in investing, and a strategy that offers this kind of payout comes with some pretty massive trade-offs.
So let's get right into the fine print. First, your upside is capped. By selling those options, you're essentially selling away your ticket to the moon if those stocks suddenly take off. But, and please hear this part, your downside is not protected one bit. If the stocks fall off a cliff, you're riding it all the way down. This 1-2 punch is what can lead to something called NAV erosion, where the fund's value just grinds lower and lower over time. And remember, the whole thing only works if there's volatility, plus you're paying a pretty hefty fee for the ride.
And yeah, let's talk about that fee. We're looking at 1.30%. And that's after they've waived part of their fee. That might not sound like a lot, but it's a massive hurdle. The fund has to clear that 1.30% every single year before you, the investor, see a single dime of total return profit.
So, with all these risks baked in, why are people flocking to this thing, honestly? It comes down to a battle in our own brains, the appeal of behavioral psychology versus the cold, hard reality of math.
Let's break that down. The appeal is super powerful, right? Getting that cash deposit every week feels amazing. It feels like a paycheck. And the story is cool. Sell fear, get paid. It's exciting. But then you have the skeptics, the math people, who are waving a big caution flag. They're saying, hey, if the fund's value is dropping, Those cash payments aren't profit. You're just getting your own investment back minus fees.
And really, this is what it all boils down to. The scoreboard, the only thing that actually matters in investing, is total return. That's it. It's the change in your account value after you factor in the price moves, the distributions, the taxes, and the costs. That weekly dopamine hit from a cash deposit is nice, for sure, but it can be incredibly misleading if your total investment is actually going down.
Okay, so let's bring this all home. I want to give you a simple, actionable framework, a mental model you can use to decide if a product like ULTY makes any sense for you and your portfolio. Just ask yourself these 4 simple questions. 1. Am I really truly okay with giving up most of the upside while taking on all of the downside? 2. Can I stomach the fact that these weekly payouts are going to be all over the place? 3. Am I cool with the fund literally just handing me back my own money sometimes? And 4, is the amount of money I'm putting in small enough that I could watch it get cut in half and still sleep at night? You know, if you're answering no to any of these, that should be a huge red flag. I love this quote. Treat it like hot sauce. It's the perfect analogy. This fund is not the steak. It's not the main course of your investment dinner. It's a tactical tool, a flavor enhancer. A tiny little bit might add some spice, some income to your dish. But if you try to make it the whole meal, you're probably going to end up with some serious financial heartburn.
So, what's the verdict? Is ULTY an innovative new tool for income investors, or is it a high-risk trap just baited with a number that's too good to resist? Well, the truth is, the answer really depends on you. It depends on you understanding the mechanics we've just gone through. And it depends on you being brutally honest with yourself about the trade-offs you're willing to make for that weekly cash flow. The key, always, is to look past that flashy headline number and focus on the only thing that matters, the total return.